get up to that point. Will it do so before the close of today? I don't know. I don't need to do it because I'm not trading it. But you knew about it on the 13th of June. All right, so where are we at here? All right, let's go to NASDAQ. 1, 2, 3, 4. We only have 4 more markets to cover. I'll be blending in the FOMC setups and how to trade that stuff as we talk about each. So go back to daily, NASDAQ. All right, so there is the setup that you saw me trade yesterday on my cell phone. So I apologize. I know some of you are like, why didn't you record the whole thing? Like, because I had a guy here trying to teach me how to use my pool and use the setups and such, and it's something I'm not used to worrying with. And as he's talking to me, I told my wife to pay attention to this part because I'm looking at something. And I was trading in the NASDAQ, and I was able to capture a little bit of it. But anyway, the the NASDAQ. Let's go back. I'll put these executions back on in a minute. Give me a second. So on the 13th of June, ahead of CPI, I mentioned, as I was meaning to mention earlier, that I didn't do so, but I'm going to do it here. CPI number. I am generally not accurate ahead of it, meaning that there's only been a few times publicly that I've expected certain things to unfold in CPI, and then it happened. Most of the time, I'm wrong. So does it surprise you when I tell you, as my students, not to try to trade ahead of CPI? It shouldn't surprise you. So because I'm telling you not to trade in advance of something, I'm trying to illustrate to you in no uncertain terms that there's a great deal of risk in doing so. So if I'm not able to do it, and I'm supposed to be teaching you, why would you want to trade it? You're gambling. I am gambling if I try to determine in advance what it's likely to do. So I set parameters up like I did on the 13th. I told you where the buy side and sell side was, and I gave you the fair value gap. And then as each was traded to, I told you what would be delivered to next. So it went up to the fair value gap, which we'll look at in a minute. It went down to the sell side real quick, all in 1 minute, and then went for the buy side. And I told you it's going to pull back into the middle, consequent encroachment of that range that defines both the buy side and sell side. And I'm probably talking too much for not having the chart in front of me, but the main takeaway was because of it being ahead of a CPI number, I was making allowance for the sell side below here, which is right there on this day. I was expecting it to be potentially a wipeout where they could come down, spike into this, and still resume going higher. I was expecting that because that would be a classic CPI. It's a classic FOMC type thing. It's a classic non-farm payroll event where they use the smokescreen of that high impact news driver, upset daily liquidity, which would clearly you can see these are relatively equal. So there's a lot of sell stops resting and it's been trailed up through here. So that's why I mentioned that CPI could potentially use that smokescreen, or the market rather could use that as a smokescreen, and drop down there and clear up all the sell side here just on a wick, and then we'd still be where we're at here, maybe even higher. It's a scenario I offered up as a reason to be cautious. If you stick to that as what I expected for NASDAQ ahead of CPI, I was wrong. And that completely solidifies why I tell you don't try to trade ahead of it. Because there's so many variables that could take place, so many things can happen. Nobody really knows what it's going to do when it happens. And when it does happen, I showed you and you watched it live, those that were in there. And if you didn't see it live, it's in the recording. It's moving and traversing so fast that there's no way you're getting filled, and all brokers pull liquidity. You're not allowed to trade that because, like I mentioned at the time in that live stream, it opens them up to unnecessary risk. So they claim that there's an absence of liquidity, like traders aren't willing to trade it. There's a lot of people out there trying to gamble on it, but they don't want the likelihood of some Yahoo getting lucky with an over-leveraged trade that they're B-booking. And B-booking is when a broker trades against you. And yes, it does go on. But if you learn how to trade well, you don't need to worry about that. So here we have Thursday today. Here's Wednesday, Tuesday, the 13th. as I was mentioning, I was expecting some wild whipsaw, and CPI can do those types of things, but it was kind of muted to the downside and offered still continuation, up. So we're going to drop into a 60-minute chart. Okay, and you can see how this type of move right here, FOMC, CPI, non-farm payroll, all those things tend to be a characteristic of those types of news drivers. So a high impact news driver, for your notes, it can occur on a medium impact news driver, but most of the time, a high impact news driver is when I expect the worst case scenario in terms of where the safest retail spot of anyone that's in open profit, meaning the market's been going higher. This is a general rule of thumb. So we're not really talking about this market per se. It's every market. If the market has been going up for a while and it's been classically seen as an uptrend, everybody that's long should be in profit. A high impact news driver, my mindset is always it's going to run against that, either to reverse on them or to offset any trailed stop losses, so that way they can be utilized to be a counterparty and then resume that existing primary uptrend. So I'm always looking at these high impact news drivers to go after for the purposes of unseating profitable positions, and then it resumes. But if it reverses, I'll know if it's a reversal at the time of delivery. So that's why I have to wait. I have to wait for CPI. I have to wait for FOMC. I have to wait for non-farm payroll if I'm going to trade them. Mythbusters, ICT edition. You see people say, ICT says never trade on Mondays. No, I tell you as a new student learning, don't trade on Mondays. Let Monday trade. Use the information that you get. Once you know how to trade, you can trade Mondays all day long. Okay, that's the proper context of what I said. I teach my students don't try to trade non-farm payroll, but you can trade after non-farm payroll. About 30 minutes after non-farm payroll, you can trade the gas, the inefficiencies, and the liquidity. It's easy to trade it after, but it's next to impossible for you as a new student or new trader to feel confident or consistent trading non-farm payroll when you don't have experience. Doesn't that sound like a responsible person? If I'm trying to teach you, if you're learning something from someone, especially if you paid to learn this, wouldn't you want that person to guide you away from where you're probably going to hurt yourself? That's what I'm trying to be as a mentor. That's what I've always maintained. Same way with CPI. CPI can rip your head off and shove it straight up your ass if you're wrong. That's the reality of that. It's so violent, so quick. If you're wrong, it's unforgiving. The broker's not going to say, well, I'm sorry. No, they're going to give you the worst case fill. Your stop is not going to protect you. It's going to be the worst case scenario. And it's probably going to be an instance where you wish the stop would have worked and it's running even past your stop. And by the time they remove all the self-imposed lack of liquidity, you'll get filled at the most ill position or price. That's the way it works. So because I've seen this for so many years and I've had my own experiences where I'm getting smashed around, my face ripped off or my head shoved up my own ass, that type of experience doesn't need to be repeated. Not in my students. So I'm trying to teach you how to avoid all that stuff. And it should be received with gratitude because I wish I would have had someone tell me this stuff and save me all this pain, because it was very painful and troubling to wreck myself constantly, not knowing that at the time I thought I was going to be right. And you're going to have those instances. Even learning with my concepts, you're going to get overconfident. It's going to happen. It happens all the time. My students, they get this sense of invincibility. They're invulnerable. They can't do it wrong. Now they figured it out. They cracked the algorithm. And then all of a sudden you get that one simple, stupid little losing trade. And it's always going to be on a high impact or a medium impact news driver where you thought you were going to do better than the rules. And I make that same mistake. When I lose, it's me, most of the time, always me, trying to outperform my own algorithm. Because I've been here before. This looks like a time. It's the human element that creeps in. So the more rigid you are about following rules that are not infinite in a list, simple little rules, the things that I outline when I tell you, look for this level to act as a means for a premium to then distribute price lower to this discount. Okay, that's pretty simple. It's giving you a framework. Then you gotta simply wait for time. I've told you the times that we're waiting for it, but now we're in stock indices. So it changes a little bit. Okay, it starts at 8:30 and goes to 11. There's your morning session. Then you have to worry about trading the lunch. Are you a lunchtime trader? Yes, you can trade lunch. You've watched me whip the shit out of these markets trading that lunch hour. But as a new trader, you shouldn't try to do that yet. Stick to the morning session, then trade the afternoon session, or one or the other. If you make money in the morning, don't trade the afternoon as a new student. That doesn't mean everybody stops trading and don't trade the afternoon session because they made money. ICT's giving you bullshit, whatever, because they want to cherry pick things out of context. I'm telling the new students, don't try to do a lot. Try to find one good setup per week and then build on that over time. You can see clearly there's a lot of opportunity, lots of opportunity to find setups after setup after setup. But if you feel like a kid in a candy store, you're gonna try to do everything, and that's not a good thing. You want to just pick your shots, know what you're trying to do, and focus on that only. And that's what these discussions help you be reminded of, because it's very easy once you start making money, whether it be in a demo, a funded account, or live, you get drunk. Like you get drunk on winning, and you think that I can go in there again right now. It's still running. Let me get in there again. Oh, it's still got some more juice in it. Let me get in there. And then that's it. You give it all back and more. And then you're mad at yourself. You're mad at me because you think I caused this bullshit. You brought on yourself. If you didn't listen to the dry points and the boring parts, that's why you're wrecking yourself. And if you've wrecked yourself, go back and listen to those boring parts of the lectures, because that's the shit that keeps you on the straight and narrow. So anyway, here's NASDAQ hourly chart. And where are we at here? 8 a.m. So we have this big wick here on the hourly chart. Trying to figure out what this is here. I'll bring it back up in a second. Body to low, and I have the gradients in here. Okay, so we can see to midpoint, which is consequent encroachment of a wick or tail. For your notes, I failed to mention this earlier. I apologize for the folks that don't know. I treat every one of these tails and wicks, I treat them the same way as I do with a gap. Okay, the algorithm refers to that area as a inefficiency or a gap, so it's treated the same way. Midpoint is consequent encroachment, and if we are looking at this wick here or tail, the low for maintaining bullishness would be consequent encroachment, which was 15,054.5. So as long as price does not close below that, everything stays bullish. The best scenario for continuation on the upside would be from the high of the wicks, or the tail here, down to consequent encroachment. Look at the bodies respecting the upper quadrant of this entirety of this tail. There's the upper percentage of it, or quarter of it. Look where the bodies are stopping. The wicks do the damage. So when I'm watching price, I don't have a fib on the wicks. I'm looking at it, okay? And I'm just eyeballing it, roughing it like this. When you're watching me do executions, when I'm reading price action live, candle by candle by candle, and I may not go into the details like this, I'm looking at that and saying, okay, roughly that's about half. And then what's half of that to the upside? We're about here. And I'm watching these candles as it happens. In this instance, or anything similar to it, are the bodies stopping at or real close to the upper quarter or half? If we start seeing a body going down into the 50% or consequent encroachment and starts going lower, or they close right on the consequent encroachment, that's a warning sign to me. I'm thinking, okay, this is probably going to give up the ghost and go lower. But simply because these two lows here are in close proximity, that's not enough to warrant that this drop here is going to keep on going. I'm looking at all these tails and I'm measuring the willingness of the bodies to close and or open at their respective either the 1/4% or half, it's consequent encroachment or the upper quadrant. Not wanting to see the lower quadrant ever being revisited. And we're not seeing that here. And the market does, in fact, tear up higher. So it's one of those things I'm using and utilizing while I'm reading price, tape reading with you all, or if I'm watching price on Twitter and I'm calling things out. I'm looking at all these things and weighing it all out. Okay, so we have a balanced price range in here. A balanced price range. Okay, what is a balanced price range? It comes in many forms. I shouldn't say many. It comes in a couple forms. But as I was mentioning earlier in the workshop video today, we have talked about how markets stay in a range. And when they leave that range, because upside and downside has been delivered on price, it makes it a balanced price range. What happens when it's done over the course of a couple candles and not a multitude of candles? Think about it like this. If I was in a live setting, say if I was on a stadium, or not a stadium, listen to me, stadium. If I was on a stage, okay, and I was in a room full of a lot of you, okay, I would right now ask by a show of hands, by raising your hand up, and you don't need to do it, I can't see you. I know some of you are going to do it. Raise your hand if you have been in trading long enough to remember what a key reversal is. Okay, a key reversal would be a day where it's like this, and this right here, all of this movement here would be absent from the chart, and you would just see the market would be here one day, and then the next day it would be gapped down here, and then the next day it would be gapped up here. And all of this movement would be invisible. All of this movement would be invisible. It would just be looking just like that, okay? That is a key reversal or a island reversal. Very, very classic, old school dinosaur type of trading. And that is essentially what I'm trying to take your attention to, because that element of separation, that once price goes to an extreme, which is what it's doing here, because see what we have here? We have a low. We run through that low, and we do it on a very large candle. And then we come back all the way back over top of that again. So these two candles right here, this represents a balanced price range because it's reached down to a level and it's offered on one single pass all this move, and the next candle over here, one single pass. So the way I do this and I define it is this. Which is higher? This candle's low that moves back inside of this up move of this candle, excuse me, this down close, this down movement on this candle eats into this up close candle, but only to this point. This low or this low, which one's higher? Clearly this one. This is the only candle that is defined in the range that this candle goes lower and this candle goes lower. So what I'm saying is the range is from here to here, extended out. Okay, so this makes a balanced price range. All of this in here, I don't care about. I could care less about that. What I'm looking at is this relationship. I'm not sure. It must be the outline. Yeah, it is. So it's the bottom one. Bottom one, right? There we are. So that's the balanced price range here. And what I'm trying to convey to you is that because we had single pass down, single pass up, this is balanced now. Once we leave it here, what that means is this range, you define it by what I just showed you here, the highest and the lowest extreme between both of these up close and down close candles, this entirety of that range. Low, to high. Where are the bodies of the candles over here stopping? I know. That's some serious shit there, ain't it? That's algorithmic. All the bodies of these candles here are respecting the midpoint of this balanced price range. How the fuck can you go back through any retail stuff and see this being taught anywhere else? It's not. It's not anywhere. These are things that you wouldn't learn by any book. None of that shit exists anywhere. This is stuff that's authorship. So when I'm watching a balanced price range, or if I make mention of a balanced price range, what I'm suggesting to you is that there is a definitive boundary that at which I don't want to see breached on a candle's body. Okay, I don't want to see it move beyond this. In this case, we were looking for what? For dollar, move lower. So a lower move in dollar is what in other asset classes? Risk on. Risk on is dollar lower. So dollar lower, all foreign currency higher, and it gives the freedom for stock indices to go higher. Knowing that the dollar index and index futures are not lockstep, every point higher is a lower move in this or that. It doesn't move like that, okay? Much like when I taught bonds and the yields, how the yields will move and they'll cause a long-term effect on foreign currency because they're going to chase that yield. But the yields can change, and the delay between all of that shifting in the currency, it's not an immediate thing. Just like commitment of traders, net trader positions. Just because the commercials are net long doesn't necessarily mean it's time for you to go long. So there's rules to all these things, and that's why it's important not just to simply watch one video or one lecture and think you come away with understanding. It doesn't work that way. But when I give a boundary to a marketplace and I code in a limitation of how far the market's going to go, it's limited to a degree of this is how far you're allowed to go. But then the wicks are permitted to do a certain measure of damage, which is what we're seeing right here. The halfway point of that range, nobody's going to look at this stuff here, okay, and define it like that. It isn't anywhere else, okay? I codified this, so I want you to understand that. These candlesticks are supporting the idea of the principle I'm teaching to you. It's not limited to just this. It's happening every time I tell you there's a balanced price range. This is what's occurring. The market's returning back to equilibrium. That's what this is here. Okay, it's not consequent encroachment. It's not mean threshold. It's equilibrium. A balanced price range is going to go back to equilibrium. The bodies in here are supporting that. As long as we don't get any close lower, there is no manual intervention. If it does, there's manual intervention and you abort it. This is just supporting the idea that it's going to go higher. So what you want to see is you want to see the market want to move up, and then create more power 3. Power 3 is open, down, close, rally, close on the high. Open, drop, rally, close on the high. Do we see it here? Drop small, rally, up, close. Open, drop down, rally, come back, still an up, close. So much of a small little movement you can't even barely see it, but up, close. We open, we drop down, rally, up, close. What is order flow? What is the order flow at that time? Is it bullish or is it bearish? Bullish. At this time right here, okay, on this candle's close, on the very next candle, on a 15-minute basis, you can use power 3 on that one 15-minute candle right there. As it opens, it drops down. You can be buying anywhere in the upper 50% of this candle here and expect this range here to stay open. Why? Why would this be expected to stay open? You see this candle right here? This is the same thing occurring here with more candles in between. This is all time distortion. I know this is too complicated. Fuck this. Give me a moving average. I know some of you were getting frustrated because but you want to learn, and I'm willing to teach it to you. But you don't need everything. But I'm teaching you how I do these things. How do I determine when I'm doing live executions? I say this is going to stay open. It's optimal for this fair value gap to stay open. You're asking me to teach you, so I'm teaching you. The same element of delivery here and here, that one single candle right here. Imagine this one candle. If all these candles from this candle here to here were compressed into one interval, it would be the same thing happening right there, just more candles. That's all that's happening. So my eye is going to this, to this. So now let's use the same criteria, okay? Which is higher, this low or this low? This low. So there's your, we don't want to anchor it to that, okay? Draw that down. Come on. I use it's not a mouse, it's a touchpad thing. Which is lower, the high of this candle or the high of this candle? Let me take this off so you can see. Get off. This high or this high? Which is higher, this one or this one? This one. So this high and this, this low and this high is the two reference points. But you want to expand it down. You want a full encapsulation like we did over here for a balanced price range. So this is a lower fair value gap than this one. To what degree? What measures the distinction between this being lower than that one? It's this candle here. In other words, think of it like this. I know what I want to say, I just can't find the words to. They're escaping me. All right, if we were looking at both fair value gaps like this, which one's higher? This one, right? So to identify and map this out, we use this one as the high, and we drag it down to here. Okay, so all of this is a balanced price range. It should never come back down and through the midpoint of that, meaning there would be a small portion of this gap left open. So let's play devil's advocate for a moment. Say it went down into this range. I would not be concerned about it doing a complete closure here because we have this fair value gap and this fair value gap that basically overlap in this range right there. So we have this portion over here and over here. So this creates what? An island reversal. Multiple candles that are segregated from all the movement here and here. So how I internalize it is all of this right here was manipulation, just like all of this is manipulation. So the purpose is to offset existing liquidity for the purposes of anyone that would be profitable once we get above this high. It's all spending time down there to allow offset longs to be taken out. And who would assume that position if they're getting knocked out? Smart money in the market rallies. Admittedly, balanced price ranges are going to be requiring a lot of education, a lot of teaching. Okay, and I promise you that you don't need it, but you asked me to tell you how I know certain fair value gaps are going to stay open, and I'm not hiding it from you. I'm telling you, this is it. This is what I'm doing to do that. Okay, they're all principles and concepts that I'm using to implement to determine when fair value gaps are going to stay open. And I know I'm talking to you right now over this chart that's after the fact, but I don't know how many of the examples you've watched me trade where I'm doing live examples. I'm entering and I'm managing the stop and I'm taking partials and hitting targets. I don't know how many of those examples I've shown or that you've seen, but they predominantly have been shared on Twitter because I usually put music behind them because I like to do that. But I still show them on my YouTube channel too, but most of the time they're being shared on Twitter because it allows you to see a very small 2 minute, sometimes less than 2 minute and 20 second compression of me executing. And every annotation I'm talking about and showing, if I'm talking about how a fair value gap should be, it would be optimal for it to stay open and not close. I'm using that either as a breakaway gap. These are the two primary functions, okay? Either I'm treating it as a breakaway gap and it should not close fully, meaning like this gap here. Let me draw it in. Man, I should have charged admission today. This is too good for the books. This gap here, it should stay open to be optimal. That means it's the best case scenario to see this stay open. I would say that about this one regardless, because it would be treated as a breakaway gap. Why? Because this over here is a balanced price range and it's in equilibrium. And the body supporting that idea is seen here. Then we see price moving here, and then we have this big extrapolation, but yet to take out this high. So this is the draw. This is where price would want to reach up to because there's real liquidity above here. What kind of liquidity? Buy side. This gap is moving quickly away from all this consolidation around equilibrium based on that balanced price range. And I know some of your heads are swirling right now, like, what the hell is he talking about? Example after example, spend time with me. Every time there's a balanced price range, I will bring your attention to it, okay? I do it in live executions. I talk about it in advance. I talk about it in tweets. I talk about it in reviews, okay? The more time you see it, the more exposure you'll have to it. But for a breakaway gap, and some of you thought I'd never get to this topic, huh? A breakaway gap is expected to form when, for instance, say we're bullish on a market, and you have identified a key level that would support as, or be presented as support, and that is acting as a discount array. Balanced price range at equilibrium. That's one of the PD arrays that is not taught in the mentorship core content, where I show you the PD array matrix and I give you a spectrum of where they are. A balanced price range can exist in any place in a discount or a premium. So there's no real definitive place where they work in an hierarchy, whereas the hierarchy I show you in the PD array matrix, the ones that are there, that is a static, that is very finite. They nest in that order. But there are other PD arrays, like this one I'm showing you here, and like event horizon. Those things can exist in any range of that spectrum, which we define as a discount or a premium. Okay, so, and if you're brand new, that just completely went over your head, but I promise you, dig into the content and it's there. Don't try to think you're going to learn how to do all this stuff right away. And you don't need to know everything. You don't need to know a fair value gap that stays open. You don't need that to be profitable. But I'm making it available to folks that want to know everything that I'm willing to share. So you asked, I'm teaching you how to do it. So even if this didn't have this gap over here that creates a balanced price range between these two fair value gaps, the fact that it does this move here and creates the fair value gap, notice there is no gap here. All through here until this candle forms, no gap is there. Everything is efficiently delivered. Every previous high is touched. Every previous high is touched. This one goes outside the range of it and even goes deeper. But then you have this big extrapolation of the upside. So this gap here, even if this wasn't here as a fair value gap, this gap that's shaded here, I'm being conscious of whether or not this live stream's keeping up with, because I noticed the one on the 13th when I was moving my cursor around, what I was talking about wasn't showing on my cursor. So I'm hoping that's not the case here. But the one that's shaded, let's put it that way, I would treat that regardless of the gap on the other side here. Whether that's there or not, this is classified to me as a breakaway gap. Meaning that a breakaway gap, I don't want to see it completely close in. It can come back down to half of it, but because there's a balanced price range here, I wouldn't want to see even half of it traded to. So then you would see me say, I want to see this trade, remain open. It would be optimal for this to remain open. But the very next candle here, the same thing. You would expect it to do what? You can see it open, and then the previous candle's high over here, overlapping this one, that would be otherwise a fair value gap if this wouldn't make the low as low as it did here. This low completely returns back to that candle's high. So any movement from here down into that, you could be a long entry. Or if you're already long, you can pyramid. So when you see me showing you a 1 minute chart or a 3 minute chart, whatever time frame I'm utilizing, I'm showing you, I'm not trying to hide anything from you, but I've been very open and candid about that I'm looking at other time frames. So this is a 15-minute candlestick chart. If you were watching all of this movement from the open of this candle down to the low of it, and then we're watching it on a 1 minute chart, it would be not so clear probably to what it is. It would be the factor for me to trust that that dropped down, where some of you might be freaking out thinking, it's hitting this area or this area and in that resistance or whatever. I don't feel those problems or fear because I'm trusting that the order flow is being supported by every candlestick. That's real order flow. All the candles are supporting each other. There's no trend line required. There's no moving average required. There's no VWAP required. Nothing. It's pure price. Just pure price. And then we get one down close candle, and that happens after the high's taken out here. Where does it trade back down into? Relative equal highs. All of this overlapping in between this area here, that is creating a very strong balanced price range in and itself. All of this movement in here, it's back and forth, back and forth. So it's showing that it's not willing to go below 15,216. So what is it more likely to explore? Buy side that's existing. Where would that be? Above here, and keep pressing higher. So it's a matter of reading a lot of things that if you're really not interested in becoming, versed in what it is I teach, this is where we depart, where you're like, okay, this is too much. I'm not interested. Okay, it's just too much. It's contrived. It's conjecture. It's hindsight. It's that. But I'm telling you, everything that I'm doing when I'm doing the executions and the things I'm leaning on when I give you the analysis, like I did on the 13th, it's based on all these things at the time when I'm looking at the chart. And when I'm watching a 5-second chart, a 15-second chart, 30-second chart, a 5-minute chart, or an hourly chart, all of these things I'm looking at. Notice that the same things that I'm looking at are continuous. Discount or premium, inefficiency or liquidity. The only separation from those things for analysis purposes is the relationship to the balanced price range or the lack of a balanced price range. Did you pick that up? There's no necessity for you to understand the balanced price range. Just know that you will see things that will not present an opportunity for you because you don't understand it. Notice that you would not need this to take any trades. It just gives you more clarity about how to read price action and know where you are in that price delivery continuum. Where are we at in relationship to where price has been and where is it heading? What reference points is it using for a new point of buying, where you can then break that down into smaller fractals, which is what I've shown you here with each individual candle. Power 3 is essentially the open. If you're bullish, it's an open down move that you want to go long in. And that's the part that Larry Williams was saying he didn't understand how to do that. And he made a facetious comment saying that, I don't know, maybe if he knew their zip code, it would help, which was silly, obviously. But it to me was like a personal challenge. Like, well, shit, if he can't do that, I'm going to spend my time trying to figure that out. So that's where I got the idea of stripping down the market and looking for discounted premium, the opening price. When it's bullish, I want to be looking at the open or less to buy. Whereas at the time when I was learning from his material, he was teaching and trading with real money, buying on strength. So he would buy some measure of the previous day's range, usually 20% of the previous day's range, added to tomorrow's opening. And if it moved like that, he would buy that and consider that buying strength. I tried that and got my ass handed to me. I could never make that work for myself. I'm not saying that it doesn't work or that he didn't make money with it, because he clearly did. I couldn't make that work. So I understand when I teach a specific concept, and it might be the balanced price range, that you're probably looking at this is too complicated. Don't worry about it. Stick to the things that make sense. I did the same thing. I had a love and an adoration for Mr. Williams when I was learning all this stuff. I trusted him with everything. Okay, I was literally throwing money in brokers' accounts just to test a new thing I learned that day. Okay, so I mean, it was. I understand what it's like, the fanfare that comes around somebody that you have a lot of affinity for, but don't do that with my concepts. And really spend time with measuring what it is that makes sense to you, that you've done the due diligence and back testing and seeing what one of these PD arrays that makes sense to you. And the obvious ones, the easiest ones that you see, that's the one you spend the most time with. And most of you are going to determine your model is linked to that. And bloom where you're planted. Don't try to tinker with it too much. All you're trying to do is find something that separates from where the market is right now, where it's likely to go, and measure risk that you can afford to take as a loss. And then you repeat that over and over again. And that's profitability. That's consistency. That's continuity, which brings longevity. You don't want to be a one-hit wonder, get a 5-figure withdrawal from a funded account and say, hell yeah, I'm balling. That's not success. That's what everybody's treating it like right now. They want to get funded and get a lottery win. Okay? I'm not teaching you how to be a lottery trader. I'm teaching you how to be a long-term, consistently profitable trader. But that doesn't happen overnight. Some of you think you can make it happen like that. It doesn't work like that. It doesn't, because you're going to bring in all kinds of things that you have to wrestle with. And you're going to swear up and down that something I'm going to teach or taught or will teach is the replacement for what you think is the best thing for you. Every time I bring something new, you're going to question the thing that may be showing you evidence that this is your model right now. Don't let me sway you with something new. It'll always be on the YouTube channel. Whatever I'm teaching is going to stay up. But wherever you start seeing success, even in the early stages, don't abandon that. You have to give yourself time, and you have to stick with something long enough to know that you have a foundation in it. And you're going to see that all these PD arrays lean on one another. It's like a web that it's a whole entire structure. When I look at price, I'm seeing all of it at one time. Some of the things I want to see, I have to wait to see if they're going to manifest. And that's usually on the heel end or backside of a high impact or a medium impact news driver. All right, so let's go into a 5-minute chart. Excuse me. All right, so we have all the balanced price range, equilibrium. We have the breakaway gap. We traded above. We have a down close candle. So what is this? What's this down close candle? Bullish order block. Does it have a fair value gap? Right there. What time of day is that? 10:05. What time is that? That's your AM session silver bullet. So ICT silver bullet. You can trade this gap right here, which would be encapsulated here. What time do you start looking for an ICT silver bullet trade? If you're trading in the 1 hour spectrum of 10 a.m. to 11 a.m., you start with your 15-minute down to 5, 4, 3, 2, 1. If you don't see it in the 1 minute or higher, drop down into the seconds charts. If you're adamant about finding one, it will be there. It will absolutely be there. Let me tell you why. Okay, here's the why behind a silver bullet. Okay, there is always, folks, just like a partial profit pays every fucking time. It's 100% profitable. When you take a partial profit, it never fails to pay you. That's why I teach you to do it. You're always winning taking a partial. It never, ever, ever fails to put more money in your account. Think about that. And there's dumbasses out there that'll tell you taking partials is the stupidest shit they've ever heard, because you incur the initial risk and you take less than you tried to make when you first put the trade on. You don't fucking know if that market's going to go there, Yahoo. And you, as a new developing student, you have no idea it's going to do that either. So when it gives you the opportunity to take money out, you do it. And over time doing that, you learn more about yourself. You learn more to trust. Okay, I've seen this before. Let me expand outside my comfort zone. This is where I normally take the majority of my trade off. Let me just take a small portion and move my stop to break even and graduate in my experience and seeing what it feels like to go into these scary moments, but still taking profits. Nobody No fucking Buck Rogers jumped out there and said, I know how to trade. This is the model I'm going to do. And it's full bore, full pull, no partials, and I'm doing it all the time. That's an asshole. Okay. That's an asshole that tells you that. And it's an asshole that's telling you to trade like that. You don't know when these markets are going to have manual intervention. You have no idea when it's going to turn on you. Nobody knows that. If I didn't have the respect of the risk that's available in these markets, I wouldn't use a stop loss. And I'm the guy teaching you. I'm telling you, I get pissed off when I see students sending me their screenshots of their trades that are open. The first thing I'm looking for is where their stop loss is. And I usually bite my tongue because I don't want to embarrass them. But if you're sending me tweets and you're sending me your open profit trades, whether it be live or demo or funded account, if you don't have a stop loss on there, just know that I'm cringing. I'm cringing because you're not using a stop loss. That means you're fucking gambling. you assume that you're absolutely right. There's no way you can be wrong. And I don't even think that. I authored all this shit and I still have to use a stop loss. Because you don't know when chaos is going to show up. You don't know when uncertainty enters the chat. Some unexpected event, some bomb drops somewhere, someone declares WAR, you paying attention. So, why do silver bullets work? Why will they form? Because there's always going to be displacement between 10 o'clock and 11. Why? This is the part where you take notes, folks, okay? In the hour of 10 o'clock and 11 o'clock in the morning, New York local time, what has happened already? The market opens at 9:30. The opening bell, I mean, we've been trading all night long, but the opening bell happens. Ding, ding, ding. Everybody's now paying attention. Everybody's clapping their hands. I never understood what the fuck they're clapping for. But the bottom line is that market's open. 9:30, bells ring. Now everybody's rushing out there to buy and sell stocks. Great. Retail trader John Q. Public is watching the ticker tape and he's saying, okay, my stock opened up $2 more where it closed yesterday. This is amazing. I'm making money. Well, that gap's going to close likely and it drops down. Then after that gap fills, if it fills at all, then there's new sentiment that shifts. Okay, it either overlaps that gap and breaks down, then it treats the low of the gap as resistance and keeps going lower, or it fills the gap, rallies up, treats the high of the gap as support, and then continuously moves higher. There's your gap theory right there. Use that with new week opening gap, new day opening gap, any fair value gap, any real liquidity void. That's how you treat it. Now, what separates the support behind that gap is the consequent encroachment, the midpoint, how we trade there at time of day. At 10 o'clock, we have 30 minutes behind us, which is why I tell you the 30-minute opening range, that's important. Every algorithm uses that first 30 minutes. Every one of them. They use that to refine a very specific range to look for inefficiencies and allow sometimes liquidity to form below or above it, and they'll do another pass, go back below it, take stops out, and then run through. Or don't return back into it at all, but just half of it. And then it runs higher or lower in deference to whatever the bias would be for that day. But the main takeaway is at 10 o'clock, you have 30 minutes of trading after the opening bell. So that initial flurry of rush to do something, John Q. Public is doing their trading then. And they're usually apt to be wrong. So we allow for that to take place. We don't have any bias ahead of time. We don't care. And we wait and see where price delivers from 9:30 to 10 o'clock. Now at 10 o'clock, we refer to where we think price is going to go anyway, where we've been calling price for NASDAQ. I'm going to use the continuous contract just to get a higher time frame perspective. Okay. Buy side liquidity here. There. And we have a order block there. Why this one, Michael? This one stretches down. It's relatively equal lows also. I'm using that as a reference point. You wouldn't be wrong by saying this one. Okay, I'm just using it because it's lower, so it's a lower hanging fruit objective. Doesn't mean it's going to go there. It just means that's how I would look at it, like that. Excuse me. So if we have this buy side liquidity here as a potential draw on liquidity, and then drop down into, I forgot what time frame we were on, 5 or was it 15 minutes, right? Yeah, it's 15 minutes, right? We have this as a buy side liquidity, and go back into, well, we're looking for higher prices nonetheless. Lower dollar, risk on euro dollar higher, pound dollar higher, and equities are permitted to trade higher. Our focus was on ES. That's the one I've been teaching through. There was an unfilled or retraded to weekly imbalance or volume imbalance on the E-mini S&P. NASDAQ has been the upside performer. So even though NASDAQ has already moved up, you could take trades in ES. But if you're trying to take a trade, it's like if you want to use relative strength analysis and you want to do longs, the one you want to be trading is the one that's showing the outperformance on the upside, which has been clearly the leader in tech. So NASDAQ has been the upside leader. ES will follow in suit by sympathy. Okay, so it's a sympathetic price rally. It's moving in concert with what has been shown in NASDAQ. And it has to catch up to what what NASDAQ has done. For the purposes of making it clear, I'm going to use the June contract because you'll remember these inefficiencies. Okay, so here's the NASDAQ. Remember I told you there's the inefficiency. We already worked inside that one. If we look at it from the perspective of the ES, we only went to this high and we have yet to trade up into this inefficiency. So in my opinion, we have much more room to go up on the upside. Now, if you take that insight and you add it to the new front month based on the volume, we have this here. Okay, so this is the month that we're trading in for ES, and then we add it to NQ again. We can't pull that up because of the data is not being there. So I'm referring back to the previous month that will be expiring, knowing that we're likely to continue. But I fall away from the analysis from NASDAQ and rely more so on the ES because ES should move sympathetically higher to try to catch up. That's the theory of Six Sisters. Six Sisters, we have the leadership in NASDAQ, but in ES will try to move in concert with. So we may see in the future a consolidation or a lack of leadership on NASDAQ, and then more upside offered on a bigger day move on like ES. It might not happen, but that's how I treat the Six Sisters. So as long as the leadership issue goes higher, which is NASDAQ, that should pull up. Like for instance, all boats rise in high tide. That's the moniker I'm using here. Everything goes up when the tide goes up. So, but if you contrast that with what the Dow is doing, this thing's lethargic. It just doesn't want to join the party at all. But we were able to see it do our run to our high here. On NASDAQ, I told you I was waiting for CPI on the June 13th live stream. I was aware that the CPI number could potentially cause a big dive lower for the purpose of the sell side, but it would just be the purpose of taking out stops and then resume. That was the whole premise when I talked about NASDAQ. You can go and watch the live stream that's there in the commentary. And it was a similar idea with ES. So it was kind of like wait and see. The only thing I was definitive on stock indices at the time of that live stream, at the 18-minute and 49-second time period, I pulled up this chart here, and I said that 39,628 would be the draw on liquidity, which is the May 1st high, and that's where we saw it draw up into, and it stopped pretty much right after that. retrace lower, and now we're piercing it again. I don't trade the Dow. I use it as a barometer like I use the dollar index. So I'm looking at the relationships between the three averages. So this is typically understood as Dow theory, which I think in obviously using stock indices, it works. It's a proven method, and it's comparing the averages. They should confirm one another, and I'll show you what I mean by that. Let's pull up the ES chart, and we'll pull it up on a. So this is what I'm thinking we're going to reach up to, so that way we know in case I lose track of what I'm saying. I think ES is going to pull up into 4,500 or just below it. So there you go. You have an expectation of what I think we're reaching for. I know someone's reached out and told me that Larry Williams is calling for, a retracement or moving lower. I don't see that happening until we get up to here, for at least for ES. And I'm happy to be wrong against his analysis, but I'm sharing what I think. All right, here's a 60-minute chart. Let's do it with a 15-minute chart. I failed to mention earlier, a 15-minute chart is a bellwether chart. Like, it's, to me, like if I was forced to do anything less than a daily chart, and I couldn't do anything below a daily chart, then just use one time frame, it would be the 15-minute chart. Like, it gives you the best of the best in terms of short-term entries and targets, because everything you can find on the daily, you'll see it on this if you compress enough. You'll have better refinement of those levels too. You can get short-term trades, you can day trade, you can scalp, you can enter into long-term position trades. It's the time frame that does all. I'm not limited or satisfied with that, because that's why I go into lower time frames, even sub 1 minute, like into the seconds charts. I don't advise the new people to do that, because you can read into 15 and 5 and 10 and 30-second charts thinking you see something there that on an hourly chart is like rocket fuel, and boom, these things can move like 40 handles on something on a higher time frame basis on a news driver, and you're thinking you're seeing a fair value gap on a 30-second, 15-second chart, and you get roasted. All right, so anyway, ES here on a 15-minute basis. You click on this little thing up here for compare, and you're going to type in or find it in here, but I'm going to show you how to do it, because assuming you don't have it on your chart yet. NQU2023. If you do it like that, it's going to plot it right over top of your chart. I don't like that. Okay, what I do is I go over here and I set it to, and I know some of you are going to say, well, if you do this, you do. I know. I know. Candlesticks. You can do it on a line basis, but I'm going to show you the candlestick version, okay? I did this wrong, didn't I? Yeah, I did it wrong. I have it set up as a template. I've been spoiling myself with it. You can create little templates over here. And we'll set this on new pane. New pane puts it down below the price. And you want to do it with a Dow also. And I don't see the Dow here, so. Now, if you're going to use it as a line chart, since we're looking at lows, okay, this is how you back test, you study it and get your screenshots of it. If we're bullish and you're expecting it to see a rotation higher and some divergence, which would be SMT divergence, you're plotting on the low. So that way you're comparing the relationship of the low of ES or whatever one you're using. This would be my trading instrument. And then for NASDAQ, I'm plotting this line chart on the basis of the close. I'm sorry, on the low rather. And the same thing with the the Dow, you're going to do it on the low. And then squeeze it up a little bit. And you want to compare the low. Do we see a lower low here? On the NASDAQ we do. And it looks like we see a lower low on the Dow. So there's no S&T divergence there. Same thing here. Lower low, respectively. Lower low, respectively. So if we see a time when there's a lower low in your trading instrument, whether say you're trading ES or you're trading NASDAQ, when you compare the other averages against it, if you're long or wanting to go long, you want to plot this, and if it gives you a divergence, it acts as a qualifier. You can take and you will take trades without SMT. But when SMT forms or a divergence against the averages, or if you're using it against the dollar against the euro, or the pound versus the euro, which is a correlated pair SMT divergence, when you're looking at two closely correlated, which is essentially what we're doing here. This is a correlated pair SMT, but with index futures, if they were considered pairs. A correlated pair SMT divergence would be euro dollar making a lower low while pound dollar makes a higher low when dollar is bearish. That would mean dollar goes lower, and the one that makes the failed lower low, that's the relative strength leader. That was the one you would be going long in either euro or pound, whichever one makes the failed lower low. So there's a lot of measuring that goes on when I'm watching price actions. If you heard me many times mention, I have a lot of monitors. Okay, you don't need a lot of monitors, but you need to be able to have at least two charts open. And that could be done on a laptop, like I was showing you here earlier, or it could be a secondary monitor, in your system. It's very, very difficult to trade on your cell phone. Okay, it's not impossible. I mean, I've done it, but you are literally looking through a very small window of what is going on, and it's very easy to get fixated on whatever you're seeing in that small little 4-inch universe, or whatever big your instrument is, or tablet or phone is. You're missing out on a lot of information. And the way I trade is I look at all these other things I'm showing you here today. Each monitor has its own real estate, what it's responsible for, what markets to follow, what time frames I have on here. All of those things I'm monitoring. I'm constantly getting a new refreshed view of everything from the higher time frame down across a lot of markets that are closely correlated. So I'm using intermarket relationships and intra-market relationships, so that way there's a relationship between how markets are either positively correlated or inversely correlated, and they should agree on the most part. I'm allowing for this discrepancy or crack in correlation where it's expected to form. I do not look at charts. Okay, this is very important. I never look at charts for the purposes of finding an SMT divergence. Look at the lows here. We have a higher low here. We have a higher low here, but we have the lower low on Dow. See that right here? That's a divergence. That's an SMT divergence. I used to, when I was younger, when I was first dabbling into this, I would only look for it to form and trade based on that. And I had not handed to me. It's only when you know where the market's likely to draw to, it creates a real measure of accumulation and distribution. Larry Williams has a accumulation distribution formula, which when I first learned about it, I fell in love with it. And for commodities in higher time frame price moves, 4-hour and daily, I found that it was really good. But eventually, it just didn't work as well as I wanted it to, and didn't form enough. But I was using it as a means of getting into some of my trades when I would look for something to go long. The qualifying thing was the 50-day moving average would be bullish. In other words, it's sloping up. And then I would look for an oversold condition on an hourly chart with a stochastic and the Williams % being oversold. Then the very next day, I would look at the opening, and as long as it dropped from the opening price down, I would chase that going into longs. So I'd be going there and buying it. I would never want to go short. I was afraid to short. I didn't understand how to short. So everything I did was primarily going long. So my model would be supercharged if I saw a accumulation distribution bullish divergence. So I don't want you thinking that it's a magic bullet, okay, where all you have to do is look for a divergence and that's your entry. Because divergences, as you saw earlier when I was showing you the euro dollar events against the dollar index, there was a SMT divergence at the time. That would have been a qualifying thing for me to say I'm done and I wouldn't hold for the trade anymore. But you watch the dollar rotate go lower and the euro dollar make an even higher high. So I would have missed whatever that move is, and if it's even going higher, I don't know. I haven't seen it since we talked about it. But just for the purposes of SMT alone, that divergence does not mean anything. Coupled with profit taking when it meets the time of day where you should be trying to close up shop or at least try to get the majority of your trade in real profit and not open profit, where you actually take partials and now you're booking that profit. That to me is more meaningful in the sense of using it. Or if it does form an entry with a SMT divergence at the time of day and it fits the criteria and your draw on liquidity hasn't been reached or target has been reached for yet, then it's more meaningful to use it. But being in of itself, it's useless. Okay, it has to be used at the proper context. And I see a lot of new folks that have just recently gone through some of my stuff. They're like, I don't hear you or see you talking about SMT. It's not required. It's really not. It's just one of those things that if it's there, wonderful. I don't look at COT every single day I take a trade. You don't need it. It's just a qualifying thing that just adds more support to it. If you're a long-term position trader and you want to trade that way, commitment of traders and seasonal tendencies coupled together with what I'm showing you here, that's a winning recipe. Like that is a really good model. And just use the entry models that I've taught, like with the 2022 model or even the silver bullet trades. And you thought I wasn't going to answer the thing. You started to talk about why silver bullets form and how they form and why is it there. They're always going to be there because of the first 30 minutes of price delivery. You have 30 minutes now in the marketplace. The rush, the mad dash to get in there and do something, to buy and sell, that's already in the marketplace now. The initial surge of institutional orders being thrown out there for their clients or their own, that's in the market now too. So now we have 30 minutes behind us. The initial impulsiveness that usually comes into the marketplace is now behind us, and now we're in the first full hour of trading after the bell. The first 30 minutes is done. That's like the Asian range, okay? Now we have the real move, London. Think about it in the 24-hour cycle. Okay, I'm probably confusing some of you, but the long-term students know what I'm talking about. I'm looking at that range of the intraday movement on the morning session as the same impulsiveness that comes into London, where there's a lot of volume that comes in Forex. That same thing occurs in that first full hour of 10 to 11. They all want to make a mad dash to find profitability. And a lot of the algorithms wait for that first impulsiveness to run higher or lower, and that inefficiency that you find on the time frames and the models I'm showing you, they all dogpile on it. They all dogpile in on that one there. So it's not a measure of the selling or buying pressure that's pushing it. It's the algorithm itself is offering it to them. It's going to move from that fair value gap to wherever it's going to go, regardless of how many people buy or sell into that gap. It doesn't make a difference. Everything in price is scripted. It's completely manipulated. It's absolutely controlled. And the only thing you're trying to do is look for that small little inefficiency when you know where you're aiming for. You're aiming for some higher time frame target, like we outlined for Eurodollar and the dollar index. If you have a higher time frame bias, and we know that that's a directional bias that's looking for a reason to go higher, it would make sense for us to expect some kind of run higher from 9:30 going into 10 o'clock, and looking backwards and seeing in that price run higher, was there any inefficiency or fair value gap? If there is, then we can use that as an entry that has to happen at 10 o'clock till 11 o'clock. The fair value gap doesn't have to form in itself inside of that 1 hour period. It can refer back to some fair value gap that formed, in the run up, if it's bullish, between 9:30 and 10 o'clock. And if you're bearish and you're expecting it to move lower, the fair value gap could form in the move from 9:30's opening down to 10 o'clock's low. So that price leg, wherever the fair value gap would reside there, it can return up into that. Many times you're going to see a lot of the trades that I've taken in the past. If you go, that was one of the things I wanted to ask you as a community. I know some of you out here save everything I do, and I love you for that. Has anybody got a full collection of every single execution I've ever made public? Because I don't know where they're at. Once I put them out on Twitter, like, I don't know how to find them. There's a lot of them. I just don't know where they're all at. If somebody could like create I don't know, maybe a thread and throw them on that'd be awesome. I'll retweet it if you do it. But I would like to see them all. And you can see a lot of things I'm teaching you will make much more sense to you now that I'm teaching you like this. You'll go back and say, oh shit, there it is. I can see he just talked about that. There it is. He's doing it. But in the early stages, I wasn't trying to teach a lot of that because, I even told my private mentorship groups, I said, look, I'm going to demonstrate it, but I'm not going to go into the detail about what it all is until some jackasses want us to go out there and start selling my videos. So now I killed that whole show and put the core content videos up on my YouTube channel. That's another reason why it's not coming down when I leave in November. So anyway, we talked about gold too. I want to do gold, and I'll teach you the FOMC setups, and then we're done for today. Let's go into gold. Let's go to a daily chart. And I always use forex.com. I don't have an account with them. That's just the feed I go with, and I trust that one. I don't look at Oanda or Pepperstone. I don't use any of those other ones. It helps provide a consistent medium for everyone, because especially if we're using forex, if you look at different brokers, they're going to have a different opinion about what the high and low was, right? All right, so anyway, gold. At first, when I opened it up, I said, I wouldn't touch it. I don't know. But like I always do, I said, gun to my head, I said, I think we're going to go below the sell side here, these relative equal lows. So again, you can find that at the 20-minute and 5-second marker of the June 13th, 2023 video with analysis. Okay, so let's go into this, and we'll segue into the Forex, not the Forex, but the FOMC, how to trade it. And it's the same premise that I'm going to teach you, that it's the same application, whether you're trading non-farm payroll or FOMC. They're treated the same way. FOMC generally is a much more larger magnitude of a move, but they're using the same macro. They use the same thing. It always happens the same way. It's just a much more muted event when it's non-farm payroll. So anyway, I took your attention into these relative equal lows. I said, okay, I think it's going to go there. So that's what I thought was going to be the draw. That's what I thought we would reach for. And I didn't say anything beyond that. Okay, I didn't say anything lower. I didn't say anything higher. I said, this is where we're going to reach for. So that was said to you on the 13th of June. So let's go into a 15-minute chart. We'll get through this one pretty quick. Then we'll take a 10-minute break, and then I'll come back and teach you how to trade FOMC and non-farm payroll. And then we'll bid each other farewell. Okay. All right, so this line is that level from the daily chart, which is the relative equal lows. It's the 1938.20 level. Okay, and we would be looking for a drop down, going lower. And I should have dropped into a 60-minute chart. Why did I drop into a 15? Okay, so there's those relative equal lows from the daily, but now seen on an hourly chart. And you can see on the 13th, we created another low here. So resting below here was a large pool of what kind of stops? Sell stops. Why would they be sell stops down there? Because look at the movement from here up. Traders are going to chase that. It goes down, they see it doesn't go here, and it rips one more time. So what are they trying to sell the idea of? When I say they, it's the real market makers. It's the folks that are controlling price. And yes, gold is one of the highest manipulated instruments there is. It's literally a joke, and that's why I don't like trading it. I know a lot of you like to ask about it all the time, but this one is extremely manipulated. It's like the Japanese yen. Like, I can't stand it. Okay, it's so absolutely ridiculous how controlled it is. I choose not to touch it. And just like the Swiss franc too. Good grief, he's naming everything. Below this low and this low, there's sell stops. Below this low is sell stops. So they were selling the idea that this is a trading range and buy it. Think about it. There's so many people out there on YouTube. They're still making videos like this today. I have a range here. Every time we get to the low end of the range, you got to buy it, and you can make money every time. And all of a sudden, I did that kind of stuff. At 20 years old, I did all that. The indicators and the oscillators will tell you every single one of these lows at the perfect oversold condition, and that's what tricks you. So when I stopped looking at the market like that and looked at it from liquidity or inefficiency, then I didn't rely on the overbought, oversold. I could see overbought, oversold relative to the range that we're trading in, which is really what mathematically is being done and tortured in indicators. Like you're defining a look back period, generally 14 period, 10 period, 9 period, and then you're basing that range as high and lowest low and where you're at in relationship to that. So you need an oscillator to tell you that. Like this right here, we're above 50% of this high to that low. Below these lows is sell side liquidity. Gun to my head, I told you that's where I think we're going to trade to. So is it higher after the 13th when I told you that? No. It only went up to go to a short-term premium. That short-term premium is relative to this high down to that low. At equilibrium or higher is a premium. We're definitely in a premium. Okay, so we don't need to see an oscillator tell you it's overbought or oversold. It's defined by that. If you pulled up a Williams percent R 10 period or a stochastic, it's going to show you overbought right there. I don't need to see that. I already know it's there. Once you understand how to read price and read what range you're in presently, it's easy to identify what is an overbought or oversold, and you don't need any indicator to tell you that. You don't need to see a moving average crossover or a MACD to tell you where market flow or market momentum is pointing. Look at what it's doing. It's building a narrative that this is supposed to be trusted as support. And that's building and engineering sell-side liquidity. So when that occurs, and I'm sure some of you watched it rally up here and thought, on the 14th, ICT's got it wrong. And the only thing it did is trade up into a premium and then wipe out. They ran right for those sell stops. What was the reaction after it did that? Look where we're at now. Now, I'm not suggesting that there isn't opportunity in this market or there wasn't an opportunity, because there clearly was. I don't want to trade in these market environments. There was a time as a young man in my 20s, I wanted to capture these moves from here to here and here to here and here to here. I wanted to be in everything. And I discerned that while it's possible, I didn't have the aptitude to be able to do that yet. And I lost money and blew accounts trying to do that. Trying to learn how to do it with real money. It does not work. You have to know what you're doing and be bored with the things that you're doing in that process over and over and over again before you even think about putting real money in there. So anyway, let's take a closer look with it in the 15-minute time frame. Now we have that context. At 2 o'clock yesterday, there was an event that took place. And what event was that? FOMC, right? So at 2 o'clock, whenever there's an FOMC event, it's to be treated in 2 stages. Okay. This is going to be a general rule of thumb. It will serve you more times than not. You will lose money on it eventually if you push it every single time. I promise you that. But if you go back and study old moves, you'll be quickly convinced of what I'm about to tell you. My long-term students know this, and we expect it all the time. I had 2 folks tweet to me yesterday who I can't deal with people. If you're going to come in and you show me this type of perspective or mindset, you are not ready to learn from me. So I just block them. It's not because I don't want to take heat from people, because my biggest trolls are not blocked by me. So it's not a thin-skinned type thing. I don't have time or energy to deal with people that are closed-minded. And if you're brand new and you come to me on Twitter and I share an example of me executing, I hate seeing, oh, after the fact again, or someone supporting that idea. Immediately, you're showing me that you are not there to learn, or you're not in the proper mindset. So I broom you quick. I get rid of you. If you think you know everything, or if you think I owe you an execution to put you into a trade that you can copy me, you don't know who I am. I'm not promising you that. And that's one of the biggest things, a pet peeve. I don't want anybody being able to copy me. I got people constantly asking me, what's the color of your candles? I know why. Because they want to take the videos like this one that doesn't have a watermark on it. And anytime I do an execution, unless I have my watermark in it, they invariably find their way onto TikTok, they're on Instagram, they're on Facebook, they're on YouTube under somebody else's thing saying they took the trade. So I don't like that. Okay. I know my own trades. I don't need to, like, you can block out everything. I know who's trading that. If I'm looking at it, I know it's me. And everybody else can recognize when I'm trading, because it is what it is. But I don't want people copying me. So if you're new, and like this is the first time you listen to me, I call things before it happens, and people will tell you it's easy to do that. Anybody can do that. But these same people are all day long saying, "Oh, we got to watch to see if it's going up here. Oh, it could go down there. You got to be careful. Oh, it's getting tight in here." And all of a sudden, after the fact, they'll say, "Didn't I call all this stuff?" No, I say, gun to my head, this is what the fuck's going to happen, and there it is. Even if I'm not certain, I will tell you what side I'm on, and I'm comfortable being wrong in those instances. But when I don't say gun to my head and I say this is where I think it's going to happen, bet your fucking ass is going there. Okay, that's what's happening. So I'm not in this business to try to have an opportunity for all of you to copycat me. I am in this business to tell you how to do this. I don't need to be doing this, but I want you to succeed. But you will not succeed by copying me or trying to get money right now because you're short on change, and that'll inspire you to do it. If you don't want to learn how to do this by what I've already shown or taught or see my students doing, nothing's going to convince you. So that's why I distinguish the grade of student that comes to me, the people that just simply want to listen, learn, and practice and put the time into it. They're not going to complain, and they're not going to ask for more than I'm already giving them. And that's the people I'm teaching. That's the people that keeps me coming back here. I broom entitlement. I get rid of that bullshit. I don't have any tolerance for it. And you can have the opinion of me whatever you want. I don't care. But I'm the only motherfucker out here that's telling you where it's going to go precisely every single week, and I'm asking nothing for it. Nothing. I'm here all day today. So just know that you're not obligated to be here, and I'm sure as fucking obligated to teach you any of this. I love doing it, but if you come to me on social media and you talk that nonsense to me with an entitlement mindset, or, oh, it's after the fact, and you didn't go through the process of hearing me explain how all these things happen, I've already taught how this works. And the reason why I'm saying this is because I'm about to teach you how to trade FOMC. And it's the same thing with non-farm payroll. The same macro that's being utilized, okay, it's a 2-stage macro. That means it's a first run and then reversal, okay? It doesn't happen every single 100% of the time, but most of the time, unless they intervene, that's what the macro will do. It will go to levels as you watch me call out on the CPI. I told you where the fair value gap was. I told you where the 2 pools of liquidity. The very specific elements that led to that delivery at CPI, it happened. You can't trade it. It's happening too fast, and the broker will not let you get filled. Anybody that shows you them getting filled, that is a bullshit, white label, fake MT4 horseshit. It's fake. It's fake. It's fake. I don't give a fuck who you are. It's fake. You are not getting filled on those things. It's not happening. Period. But if you wait until these reports come out and that first initial surge, and they put the availability of the trade back in place, all brokers pull their shit. They don't want to be getting caught on the wrong side of some goober that got lucky. That's the reason why it happens, folks. It's not because nobody wants to trade it or they're scared. The broker doesn't want to have that incurred risk. That's the reality. That's it. That's what's going on. Okay? But they call it something else because think about when you look at it that perspective. It's like, you assholes. I could be making money right here and you're preventing me. Yeah, that's exactly what they're doing. They're saving their own ass. They're protecting themselves. And guess what? I'd be doing the same thing. Because you can get lucky. I got lucky. I got lucky for months early on. I did. And then found out I didn't know shit. So would it make sense for someone that has millions of dollars available in customer deposits and they are over leveraging that 30 to 1 and they get right on an over leveraged position on a big fast runner, 100 handles in NQ, 50 handles in ES? Come on, man. Like, you wouldn't take that risk on either. So you can't fault them, but it's just the reality of this business. It is what it is. But you don't need that first initial surge. It's better for you to wait. And they paint all these scenarios with the first initial run. Oh, it's going to keep going lower, or it's going to keep going higher. So think about it like this. At 2 o'clock, we see gold do this run here. Rips lower. Remember, this is the low I told you it was going to go to. Did it go to it at 2 o'clock? It's a 15-minute candlestick, by the way. It drops down, but falls short of the objective, and then leaves this low and this low as relative equal lows. And then it rips up higher. What's happening here? What's occurring? It's setting the stage for traders to suspect that this is support. We can go long. It's going to rally. That's not what we want to see. Go into the expectation I teach you, where the fair value gap or the imbalance, it drops, leaves this inefficiency right here. When it drops, it comes back up into it there to offer an opportunity to go short. And then it delivers where I said on the 13th, which is that relative equal lows on the daily chart. It digs into it here, lower, lower, one more good time, and then rips higher today. All of this price action in here, I'm telling you, I would not be in any of that. Not in it at all. If I was looking at gold real time, I would have told you that it's possibly going to go here, but I wouldn't touch it. And that's the honest God truth. Ask any of my long-term students. I say this all the time about gold. I don't know what it is, this fascination with trading gold, but there are better markets to trade than this bullshit. But that two-stage or second stage of delivery after 2:30. See, the first move is like a red herring. Hey, pay attention over here. Look at all this. Okay. And then at 2:30, that's the real move. That's the real one. Okay. So it can come in two forms. It can go rally up, suck everybody in thinking it's going to go lower, and then it wipes them completely out and goes lower a lot. Or it can drop lower, get everybody thinking at 2 o'clock that it's going lower, and then at 2:30 it rips and takes out the high that was formed prior to the drop. Okay, that's the buy or sell in that way. The other thing is where it drops down a lot, leaves a fair value gap, and at 2:30 it'll go back to the fair value gap, and then the real run comes. Most times it does not do this. Usually it creates a run, one direction, and that direction is a complete Judas swing, where it runs, creates a high, it doesn't come back to that high, and just makes a lower low on the day. ES. Two o'clock. I know I've got people sending me messages saying that the title's wrong. I know it'll be changed. I mislabeled my notes Friday and everything since then. I mentioned it earlier in the recording. But the 2 o'clock is the initial leg of FOMC. We dropped, rallied higher, fair value gap, drops down, rips up higher, and then one more time drops lower. If you look at the first move going into 2 o'clock, what is the first move? It's dropping down. So it's setting what's the expectation? What's retail going to think it's going to keep doing? Lower. This fair value gap is utilized twice. 2 times. Trades into it here, rallies. They dig into it again today, one more time, and then they send it higher. On NQ, this will be much more impactful because I actually executed on it. It's all hindsight. All right, so we have ES. We started where I showed ES, so this is the NQ, and I want to take everything off this, strip it down to nothing. All right, so here we have NQ. NASDAQ delivery contract month is September 2023. Inside this drop, okay, think about what I've talked about here. Think about what I've been talking about for weeks in relationship to ES, E-mini S&P, and the NASDAQ futures contract. Which of those two has been the leadership on the upside? Which one has the strongest price delivery for being bullish? NQ, NASDAQ. So if we consider trading FOMC, doesn't it make more sense if we want to go long? Why would we want to go long? What was the move that took place on the drop down into 2 o'clock? It's dropping at 2 o'clock. So there's your fake move. So this drop down here, and then they hold it here. Holding it. And at 2:30, the macro begins. So when you're trading FOMC, if you're not writing this down, you're completely wasting your time. You have to know which of the indices that you're going to trade because of relative strength. Which one's stronger? There's always going to be a leadership issue, whether it be NASDAQ or ES, Dow. Okay, if it's Dow, I just go to ES. If it's NASDAQ, I will trade NASDAQ over ES. If it's anything leading to the weaker or the stronger for the Dow, I always elect to use the ES as a deferment. I defer myself to trading only ES, not the Dow. So if it's a matter of picking which index I'm trading, it's either a decision of whether trading the NASDAQ, and it has to be the leadership on the upside. That means it's been going up longer, harder, faster than ES. If ES is going up longer, harder, faster than NASDAQ, if it was reversed in its role, I would have taken this trade in ES and not NASDAQ. So the first delivery at 2 o'clock was seeing price do what? Drop down. I'm going to go into a 5-minute chart. When this market dropped here, where was the most energetic price leg beginning from? Here. At this big move here. I'm not saying that you can't see this one as a high, or this is a high, or this is a high. but this is the most energetic. So all of this starts the run going into FOMC. So anyone that's in this move, where's their stop loss? Right above that short-term high. I'm aware, but remember, I'm listening to this guy tell me how to run my pool, and I'm not really paying attention to him. And I'm trying to get an example on FOMC, and I'm doing it with my phone, which is what you see on my Twitter feed. Okay, tools playing in the background. It's what it is. Okay, so I think it's going to go up here, but I can't pretend to be listening to this guy and watch all this watch all this stuff happen as it's going on. So I picked a very easy target, low hanging fruit objective, which is going to be the buy stops resting above this short term high. Why was I going long in here? What was I looking at? This move here. I'm sorry, this move. Good grief. This down close candle here. All of this movement in here back and forth, I'm treating that as like a very small little balanced price range. It's doing back and forth, back and forth. So I'm trusting that there shouldn't be any more meaningful run below that if we take out that candle's high. We have it here. So we take it out high. That low now becomes, that's it. There's no more need for any more risk going lower. The stage is set because what time is it? 2:25. The first stage of that delivery in the strongest of all the indices, which is the NASDAQ. I'm not looking at or caring about ES. I'm not looking or caring about the Dow. I'm not looking at relationships between the SMT. I don't care about that. It's time. The macro will run on time. It's going to favor this market because it's been outperforming on the upside. So its sponsorship is heavily on this one going up versus the ES, like it's been doing for weeks. And the Dow has already proven it's lethargic. It's not interested in performing like the ES and or not even close to NASDAQ. So all focus would be on NASDAQ. So buying, going long, right here, what am I keying off of? Look at the arrow where I entered and what I've already told you. This body of this candle, the last down close candle, I'm using it as Bella, by the way. This movement down into here, I'm buying that right there. Right there. Bought that. Then I'm using this right here, this opening price, and inside this little area here, I want to use that as a means of wanting to go long on a pyramid. So I went long with 5 contracts, which is not a lot, and I added another one, which is I'm pillaring. What am I aiming for here? Just before we get to this high, because during FOMC it could do this wild whipsaw still and then deliver up. I want to get in, or I'm sorry, I want to get out of my trade as it approaches this high. Low hanging fruit. I don't need it to go to the high or higher to get a fill. There's my exit on this candle here. All of this rundown is completely wiped out. Ultimately taking out that high here, over here. 2 stages. Non-farm payroll is the same way. It either gives you a drop, come back to a fair value gap and continue, or it gives you a drop and completely reverse and rip higher. Everything reversed. The difference in knowing which one it is how it trades at the time, which is why I have to wait. I have to see what it's doing, how it delivers, and compare it to the other averages. That's what I'm looking for. I'm looking for that relationship between the other. It's not SMT. I'm looking at who's been leading the pack, higher or lower, whenever these reports come out. And then I'm looking for where the liquidity is. Traders that were trying to chase this, they're trapped down here. They're hoping it's going to go lower. Back up it goes. Go back and look at your calendar. And every time there was a FOMC rate announcement and a non-farm payroll, Study how that liquidity is taken. Study that. It's always a two-stage macro. It always does something initially that gets people thinking it's going to do something specific, and then it rips their face off. CPI is that macro on steroids, on crack, on meth. Okay, it's literally like cocained up, the same macro, and you can't trade that. You can't. Okay, you can't. So all of these high impact news drivers and or medium impact news drivers, if you're afraid of those, just wait 30 minutes minimum. Wait 30 minutes after they form, and then see what liquidity resides in the marketplace still, and any inefficiency. And if it offers you a range that presents potential to see 10 handles, then you probably have a good chance of making 5 out of it, or maybe even more. So there's a lot of waiting around to see what happens on these big impact news drivers, because you don't know, and I don't know before it happens, how they're going to use that information to manipulate it, because they want people chasing this idea at the moment. And they know that brokers are pulling liquidity. Not that there's an absence of trading or interest. It just means that all the brokers are collectively saying, the hell with this. We are not getting caught on the wrong side. Because if they get a client or a large base of their clients that are over leveraging, and everybody predominantly over leverages, you do it too. What happens if they're right on a big move day? The brokers are out. They're not trying to do that. So wait for that initial shock, and trust the fact that you don't need that first move to make money. You don't need it. Wait for the first move in 2 o'clock in FOMC, and in 225, 230, then it's going to rip the other direction. That's what it is. That's exactly what happens. It's kind of like, well, I don't want to say it in the live stream because my channel might get flagged, but I've said the analogy before on Twitter and stuff, and I'll talk about it this weekend in a Shotgun Saturday. I'm sure you're all wondering what it is. And it's not a big deal. It's an analogy I use that has something to do with making individuals run to a specific area and then attacking that once they get there for a larger impactful, event. That's what I mean by two-stage. So it's designed to corral traders into one big area, make them think it's going to do a specific thing, so that way there is a pool of liquidity that's being sacrificed, and then that liquidity is being used for a counterparty. So it's tricking traders to go in the wrong direction and then raking them across the coals the other direction. So I think that is going to be it for today. We went through my entire hit list of everything, and I was a little bit short on my time. 2 o'clock, that's pretty good, isn't it? You got some value today. I talked about a lot of things that hopefully will amplify some of the misunderstandings or shortcomings in terms of your learning. And I amplified on things that I know I get a lot of requests for, breakaway gaps, and introduced more insight about a balanced price range, and preached that we focus on understanding which one is the leadership, and when does it matter? When does it really matter to be in the one that's a leadership? Because you see ICT trading that, yes, even though I told you NASDAQ weeks ago was the strong one. So why aren't you trading that one? Because I'm teaching you how you can still find profitability if you did it wrong. If you found something as a setup and you didn't confer with the relationships between the averages, okay? Or if you're a Forex trader, you didn't do the relationships between which is stronger, the British pound versus the US dollar, or the euro versus the US dollar. You want to be in the stronger one if you're going long. You want to be in the weaker one if you're going short. Well, when it matters most is when we have these high impact news drivers, because they're going to really capitalize and wind these markets out when they are the leadership issue. Look at the relationship between the NASDAQ here and ES. Whoops, a little extra zero there. You see it right away, don't you? It was not able to climb as high. Look at here. Here to here. Okay. I'm going to take you back to the NASDAQ. See that? Higher. That's why ICT was buying this one and not ES. And, funded account traders that have, found their way into, I guess, the part where they can make money and then take the money that people pay in and call themselves, paid out, whatever. That is a trade right here that they could do. It's not the maximum number of contracts available that they can trade. It's less than. And that run right there is equivalent to $23,000. So you tell me, is it worth the gamble of trying to guess before the fact or waiting for the initial impact crater to form, and then you go over there and find the people that you can pick the pockets of that they're dead already, they don't know it, and you go over there and you take their money from their accounts and get out and walk away. I'll leave you with the idea of that being a good analogy or not, but I'm usually the action guy that sees things from a Rambo perspective. It's just the way I look at things. But if you want to look at it as ballerinas dancing around, whatever suits you, it helps you understand what the market's doing. It's wonderful. But my audience predominantly is male, and I'm a guy, so I kind of like lean to that. But one more time, you can see the difference between the two. Much weaker on ES. Okay, so it's 2 o'clock and my stomach is growling, so the only thing I had today was bone broth, so I'm somewhat hungry. I'm trying to think if there's anything else I want to add before we close it, and I don't believe I do have anything else in addition to what we've done here. Real quick, I just want to show you the Dow. Okay, so we have a drop, the fair value gap it trades into here, and they reclaim it there today, and then they sent it higher. So there's a little bit of a delay to take out the relative equal highs. We mentioned this high on the 13th of June, and that's where it hit it and just retraced lower, and now we're climbing above it here. I'm not really excited about the Dow still. If even I was willing to trade it, I still wouldn't be interested in trading where it's at. And you might be thinking, well, wouldn't Six Sister apply to that because it has a lot of ground to gain to try to catch up with NASDAQ or even ES? Maybe. I just don't trade Dow. It's a real spotty index, and it's only 30 stocks that make it up, so it's very easily manipulated. Okay, I don't want to say it in the same way like I mentioned with gold, because it's nowhere near the degree of manipulation in Dow that is in gold. But Dow is very thin, okay, meaning there isn't a lot of trading that takes place in it versus the ES and the NASDAQ. And NASDAQ is a fast market because it's thinner too. So that's really what makes the ES a little bit slower. But sometimes there's a little bit of an inversion where ES will outperform the NASDAQ. But most of the time, the NASDAQ acts like the British pound versus the euro. Okay, ES will be equivalent to like a euro, and NASDAQ is equivalent to how British pound trades. British pound always exaggerates the move that would be seen in euro, which is why I always predominantly like to trade the cable, which is pound dollar. But there are times when euro dollar will outperform cable, and you have to know the things I'm teaching you here, the relationships of measuring when to look at it and when not to consider it. And you can't learn that in just one video. You have to see it, experience it, see analysis, see things called in advance, watch how it performs, also back test. All those things should be included when you're looking at price moves. Like when you're looking at Forex price runs and you're logging in for your journal, you want to be looking at other closely correlated pairs, not just the one that you see the setup in. So that way you're getting a real clear depiction of what everything else around that pair was doing at the same time. So that way it's not this in and of itself, an island of itself, saying I'm doing whatever I want to do. No, it's being subordinate to the macro that's underway in all the markets. So anyway, I think I've given you enough today to give myself a day off and a 3-day weekend. And I understand, yes, it's not Friday, so I'll be changing the title of this. And I will catch up with you, I'm sure, somewhere on Twitter. I don't know. But if I don't talk to you tomorrow on Twitter, I will talk to you Saturday morning at 9 o'clock for a Saturday shotgun with ICT. So I'll talk to you next time. Be safe.